Hey, if you're looking to buy a new home and then rent your existing home where you live right now, you're gonna end up paying a lot of capital gains taxes when in the future you end up selling your existing home. In this video, I will show you how to avoid those future capital gains taxes on the appreciation of your existing property by putting it into S-Corporaiton. It's a great tax strategy. It's a wow tax strategy. In this video, I will show you exactly how to get it done right. Ready? Let's get going. Hey, welcome to my whiteboard tax strategy. My name is Boris Musheyev. I'm a CPA and a certified tax strategist. I release a tax strategy video here on YouTube for you, the business owner. By watching this video, my goal is for you to start paying less in taxes right away. So go ahead, subscribe to my channel, like it, share it, and even comment below. I appreciate you. Now let's get started. Let's get started with this. Now, the way we're gonna break this down into 3 easy steps, right? First of all, we're gonna try to understand why is it that you should sell your personal residence to an S-Corporaiton to rent it out. Again, I'm talking about the case where you wanna move into a new home and you wanna rent your personal residence. But what we wanna do is put it into an S-Corporaiton and rent it out of there. So we're gonna talk about why, we're gonna talk about how it works, and then, the most importantly, we're gonna talk about a tax strategy and an example. Now, I've actually put together a checklist for you to follow. Okay, a checklist and the compliance, it's a free PDF, download it, take it to your accountant, and do not attempt to implement this tax strategy by yourself. Now, let's try to understand why am I sitting here and asking you, or really telling you, that if you want to buy a new home and rent your existing home is to actually sell it to an S-Corporaiton. Now, we need to understand personal residence exclusion rules. So the IRS says if you lived in a house for 2 out of the last 5 years, that is your personal residence, okay? And your house has appreciated in value and you made money on the sale of your house. So if you're a single filer, you don't pay any tax, any capital gains tax on that appreciation, on what you made on that gain, up to $250,000. If you're married filing joint return, that's $500,000. Now imagine, we have an example, right? Imagine this scenario. You purchased this house for $250,000. If you sell it to a stranger right now, it's your personal residence, for $750,000, you're not gonna pay tax, a capital gains tax, on a $500,000. Because you sold it to someone else and you're not renting it out. If you're gonna now move into a new residence and rent your personal residence right away, well, guess what? In the future, when you sell the house after renting it out, your basis, what you bought it for, is going to be $250,000. That means the tax you're gonna pay is the sales price minus only $250,000. Okay? This $500,000 gain is also going to be taxable to you. Because why? You've never exercised the personal residence exclusion. Now you might say right now, Boris, how do I exercise the personal residence exclusion? Because I want to rent it. That is exactly why the strategy of selling to your S-Corporaiton works perfectly here. But again, we're talking about when you want to rent your existing home and you're moving to a new one, but you want to rent your existing, we want to rent it from an S-Corporaiton, but we want to make that sale. And we're going to talk about exactly how it works in the next video right after this break. Hey, thank you so much for watching my videos so far. I wanted to give you a heads up. I've got this free PDF, 7 tax write-offs that every S-Corporaiton business owner must know. The link to this free PDF is down below in the description. So to make sure to download it, that's it. Now let's get back to the video. All right, awesome, let's come back. By the way, like I said, I've put together a checklist for you, and a compliance checklist that you can just take it to your accountant or whoever you work with, whatever tax professional you work with, okay? It's a free PDF in the description below. Do not attempt to implement this tax strategy by yourself. Now, by the way, please like, subscribe, share this video, help other business owners find this video if it applies to them. Now, let's talk about exactly how this tax strategy works. Now, let's say you wanna start renting your home, personal residence. Let's first form an S-Corporaiton. Form an S-Corporaiton, do it with your accountant, do it with a professional that knows how to do it. It basically takes forming the C-Corporation and electing an S-Corporaiton status. That's number 1. Number 2, start the process of selling your home to an S-Corporaiton. Now, what you do not want to do is treat it, not treat it like a traditional sale. definitely treat it as a traditional sale. IRS wants to see documentation and paperwork. So if you don't follow traditional sales rules, IRS might say, this is a sham, you just make things up over here. So what does it take to follow the rules? Number one, get an appraisal report. If you were selling it to somebody else, right, that other person, that buyer, right, would get an appraisal report and would say, hey, or your bank would get an appraisal report, but there would be an appraisal report to determine the fair market value. Once you determine that fair market value and you've got that appraisal report, what you want to do now is that sell to your S-Corporation for that fair market value. Now, a couple of things about the mortgage. If you have a mortgage on your personal residence, most likely your mortgage is going to have what's called due on sale clause, meaning say, hey, if you ever sell the property, you've got to pay us back the money, okay, because we lent you that money, so you've got to pay it back. So to avoid the due on sale clause, definitely first we'll speak to your attorney on this one, but when you're going to be putting together the purchase contract, purchase agreement, make it contract for deed or wraparound mortgage. Basically, in layman terms, this means that the mortgage will still stay under you. The deed is just temporarily, so to speak, passing to an S-Corporation. Now, this is not a binding contract, meaning to say, I shouldn't really use those terms, or binding contract, all this legal stuff. Meaning to say, there's no paperwork that needs to be filed with a mortgage company or anywhere else. But the beautiful thing is that for tax purposes, this is considered a valid sale. So for tax purposes, this qualifies 100% as a sale. So again, when you're putting together the contract between S-Corporation and yourself, speak to your attorney and tell them, hey, I want to avoid the due on sale. Let's make it a contract for deed or wraparound mortgage. Now, also, if there is a mortgage, try to put 10% down. You might say, well, Boris, I've got an S-Corporation that you said I need to form, I follow the checklist, okay, but I don't have the money to put it down in the S-Corporation. How do I fund the S-Corporation? Very simple. Write out a check to an S-Corporation for whatever that down payment is, okay? That will be owner contribution. I have a lot of videos about owner contribution, distribution, check out in the description below. And then the S-Corporation will pay you back the 10%. Done deal, right? That will be the down payment. Now, if you do need to take out cash, some people have a lot of home equity built in, or they want to take out cash from the house, like a second mortgage, make sure you do this before you transfer the property to an S-Corporation. Because once it is in an S-Corporation, it is S-Corporation's property. It is not your property. Now, this is a related party transaction, so avoid installment sale rules. Again, word of caution, do not implement this tax strategy by yourself, especially if you're that business owner that thinks you know everything and file your taxes on TurboTax. Please don't, okay? So what happens is that you're going to avoid the installment sale rules. You're going to elect out of it, and it's going to be a related party transaction, which is okay. You just have to follow the rules. Download my free PDF. It's for you to take it to your accountant, okay? So follow these rules. Now, let's actually go through an actual example. What are the benefits of doing this and how this tax strategy works right after this break. Hey, thank you so much for watching my YouTube video. Just a quick commercial break. If you like what you see, please like the video. As a matter of fact, share it on your YouTube so that you can help other business owners to save money on taxes. I would also appreciate it very much if you subscribe to my video. If you like, share, or subscribe, it really helps me with YouTube algorithm, where YouTube will really push this video to other business owners and they can learn how to save money on taxes using simple tax strategies that I teach with my whiteboard strategy. Thank you so much, and let's get back to the video. Welcome back. The moment we've all been waiting for, the tax strategy. So let's use the same example as before. By the way, if you haven't liked the video or subscribed to my channel, please do so. Really, what's most important is that you share it with other business owners. Just share it on YouTube, okay? So that it can help other business owners. Now, an example, same example as we had here. You purchased the house for $250,000. You're filing a joint return. The fair market value of the house is $750,000. That means that if you sell this house right now to a stranger, you're not going to pay any tax on $500,000 because it's your personal residence and you live there with 2 out of 5 years. good. But if you're going to end up renting this house, you're going to lose the $500,000 exclusion. So in this case, we want to follow these rules and sell it to an S-Corporation. Now, what are the benefits of this? There's two main benefits. Benefit number one is actually you will get an increased depreciation deduction. Remember, when you have a residential property or a commercial property, you can take a depreciation expense. The depreciation expense would be what the property cost you. So if you do not sell it to an S-Corporation, then depreciation will be counted on at $250,000. So it'll be $250,000 divided by 27 and a half years. But because you sold it to an S-Corporation as a tax strategy, the depreciation will be taken on a fair market value of $750,000. So I have an example here, year 1, year 2, year 3, what your depreciation will be on the $250,000 basis or $750,000 basis. Sorry, it's a little typo here. Right? On a $750,000 basis. The difference is more than $50,000 of depreciation deductions in the first 3 years. And I'm not even talking about doing a cost segregation study, okay, which will give you a higher depreciation. I have a video on that should pop up somewhere now or in the description below. But the difference is more than $50,000 in depreciation. So what happened? That's because you sold your property, your personal residence, to an S-Corporation for $750,000 to rent it out. Now there is a basis of $750,000. The second benefit is step-up basis. So let's say 2 years down the road, you're going to sell the property for $1 million, right? I'm just going to write here $1 million, okay? If you haven't sold your personal residence to an S-Corporation, to your S-Corporation, then the tax you would pay would be a capital gains tax on $750,000. You take $1 million minus what you originally purchased for, which is $250,000. That's a huge tax. This is where you lost that net gain exclusion, right? Where we talked about that this is your personal residence. Why? Because you haven't sold it to an S-Corporation. But because you will sell it to an S-Corporation, you'll take the same $1 million that you're going to make out of that sale, that you sell it to another stranger after a few years of renting. Your basis, right, assuming there was no repairs or anything of that sort, would be that fair market value that basically you sold it to an S-Corporation for. So now you pay a tax on $250,000, which is what happened is that you really made $250,000 from the time that you rented when it appreciated in value. Okay, so that's legit. That's good. What we did is that we preserved your $500,000 personal residence exclusion. Great tax strategy. Awesome. And I hope this does make a lot of sense. If anything is unclear or whatever it is, just ask me your questions in the comments. I'll also put together the checklist for you to follow. Thank you so much.